to Offices Adda 24/7. My name is Neharka Valia Bhatnagar and I am with you with the area of accounting and financial management. So let's begin with the class today. What's the topic for the day? The topic is financial management. Okay, so we are moving towards module C now as promised. So starting from the module C, the first thing is going to be what is financial management. Chali, let's begin with that part first. The term finance is money. Accounts is all about money only. Not even once I said that you can take up any element which is non-financial. So, under the term financial management, what is it? Finance is the money that we have. But it's not about having an ample amount of money. It's about managing that ample amount of money. Isn't it? So, management is about having the money, taking the decisions where to use this money, where not to use this money, what to look forward to when it comes to all this working. That is financial management, the management of the finances of the organization. Okay, so here comes the first question. It says, which one of the following statements about corporate social responsibility is not correct? The first question is related to the CSR. It is related to Companies Act, specifies the companies which are required to spend money on CSR. CSR spends is totally voluntary and there is no legal requirement. Only specified activities are eligible to be covered under CSR, or companies are required to spend at least 2% of their average on CSR. Okay, so if we talk about the corporate social responsibility now, so there CSR is required only for some higher level companies. For others, it is not, but it is required in certain companies. It is not totally voluntary. It is not something that you can choose. कोई बात नहीं, we will go through CSR. नहीं रहने देते हैं. That is not there. You cannot choose to go and give money for corporate social responsibility or not. It can be your own choice, but ultimately for most of the companies, it turns out to be a compulsion only. ठीक है? CSR spends is totally voluntary and there is no legal requirement. Done. Which one of the following is not amongst business ethics? Philanthropy, honesty, integrity, or trustworthiness? Trustworthiness is required because in terms of the books of accounts, how will we feel that the books of accounts are worthy of that particular respect? है ना? How would we believe that the books of accounts are prepared and they are honest? Oh, this thing will come with time, no? Isn't it? So if it's going to be based upon this, then what would be the answer? Honesty is required. Integrity for all the accounts are required. But philanthropy is the choice of the particular person, isn't it? This is not a part of the business. It is by choice that people do this. So in this case, what would be the correct answer? Done, everyone? Chale. Now let's look at the next point. The correct answer is philanthropy. You don't do the charity work in terms of the business, though people do it to adjust their money, but this is unofficial, not official. Next point, which one of the following can be considered as an agency problem in financial management? I'm not the owner of the company, but I take care of the company. You know, managers aren't the owners. They're mostly the people who manage the particular organization. So first is conflict of interest between the company and its suppliers, conflict of interest between the company and its customers, conflict of interest between the company and the government, conflict of interest between the shareholders and the management of the company. This portion is totally between shareholders and management of the company. Shareholders are the owners of the company, but they have no clue what's happening in the organization. They are not the owners of the company, but they manage the operations. Sometimes among them, there is a major problem of trusting each other. Since they don't trust each other, so ultimately the entire working goes haywire. Next, risk return. Everyone, why would you take risks in a business? What's the big reason or big idea behind taking the risks? The risk and reward is trade-off implies which of the following? Aiming at high return and low risk, aiming at low return and low return, low risk and low return, striking of the balance between risk and return. Everybody, I will take the risk only and only if I get something in return. If I don't get something in return, there is no meaning to go for the risk, isn't it? If there is higher risk, it would be a higher return. If the risk is lower, then obviously I'll expect lower return as well. For example, FDs, there is no risk there, so the return is also lower, while in terms of shares, it is higher, isn't it? So, what would be the correct answer? The trade-off is striking the balance. What is the amount of risk that we can take? What is the amount of return that we can expect? Done? Okay, next portion. Acha. They have given the answer none of the above. The correct answer is actually none of the above there. If we go for it, see, this is not right, this is also not right. But striking the balance between risk and return seems to be right, but there is one more problem. It is actually trade-off. Trade-off is the balance. Risk and return balance would be like higher the risk, higher the returns. So they are not looking forward towards balancing, but they are looking forward towards the fact that if the risk is going to be higher, I would want a higher reward. That's why the difference is in the line. Okay? Capital structure implies which one of the following? Proportion of fixed and current assets. Capital structure is what? See, if I need money in the business, it can be from two sources. Capital structure. One is when we ask for the shares, and one is debt, debentures. Equity shareholders are the owners of the organization. Debt are the loan providers. So, capital structure implies which one of the following? Capital structure would simply mean that they have to find out what would be the portion of equity and how much loan that they can take. So, second is current assets and current liabilities. This is done in terms of working capital. Working capital means day-to-day need of money there, that is working capital. Proportion of long-term and short-term liabilities, that is C. This is a part of their current and non-current scenario. While when we talk about capital structure, it is proportion of debt and capital. Okay? Proportion of debt and capital. Which of the following is the main objective of financial management? Revenue maximization, profit maximization, wealth, or cost? Which of the following is the main objective? Why do we follow financial management? Simple reason, we would like to do two things. To be very honest, the business lives on only two things. One is profit maximization. That is to increase their money. And once their money is increased, ultimately, what would happen if the business grows? Our shareholder also grows. You know? So they say, what is the ultimate goal? The ultimate goal is to keep the shareholder happy. If the shareholder is not happy, now this is where the entire thing goes down the drain. Okay? So I would say the correct answer is wealth maximization. That would be wealth maximization, everyone. Because that's the only thing which provides us the details in such a way that wealth maximization is the ultimate goal of the organization. They would always want that the business grows further, है ना? Isn't it? Chaliye, let's move on and talk about the next point. The answer is wealth maximization. Basically, now they say that wealth maximization comes from profit maximization. If the organization earns more, then the shareholder earns more. Na? The shareholder is not making money on their own, so it is directly proportional to profit. So the business should grow further. If the business is growing, then everything else will grow. A firm determines the shareholder's wealth by taking the number of people employed in the firm, a book value of the firm's assets less than book value of its liabilities, the amount of salary paid to its employees, the market price per share of the firm. A firm determines the shareholder's wealth by taking. If you're looking forward towards shareholder, you're going to take the book value of the firm. Okay, what is the value of the firm? Or either you have the share capital of the organization, number of shares do they have, and then multiplying it and finding it on. Okay. So if you're looking forward to it, if the share capital book value is not given, you take your all the assets and remove all the liabilities. What is left is your capital, the money which is invested by the shareholder. Okay, na? The money which is invested by the shareholder. So it is the book value of the firm's assets less the book value of its liabilities. Done, everyone? All the listed companies are required to prepare fund flow, cash flow, statement of affairs, or all of the above. If it is a listed company, the rest everything is definitely something which is not known. But one thing is for sure, if your company is listed, then it is compulsory as stated by SEBI to prepare cash flow statement. We are supposed to prepare the cash flow statement. So this is compulsory. Statement of affairs is not really compulsory, and at the same time fund flow is never compulsory for any organization. Okay. Then comes the next point. What do you mean by EBI TDA? Somehow we are going to use all these terms in the upcoming topics like ratio analysis, capital budgeting. We are going to talk about it. So it's just a beginner point. EBI TDA, it is earning before interest, tax, depreciation, amortization. Earning before interest, taxes deducted annually. Earning before income, taxes, depreciation and amortization, and interest, tax, depreciation and assets. When we talk about EBI TDA, what do you mean by that? It is actually earnings before interest, tax, depreciation as well as amortization. Amortization happens in case of intangible assets. Depreciation happen in case of tangible assets. That means we would like to know before we are paying off for all these things, what is the value. If this value is not known to you, you take your net profit. First of all, add back tax because that's the last thing that you pay. Then what you get is earning before tax. Then what you have to do is you add back interest. What you get is earning before interest and tax. After this, the next is you add back depreciation and amortization, if any. And this is where you will get EBITDA, earning before interest, tax as well as dividend. Note this down, this is not only helpful in your JIB examination but also in your CIB examination. So quite a powerful topic to look forward to. ठीक है ना? Done everyone? Chaliye. Now I hope you have noted it down. They have just added back the one which we normally reduce to eliminate their presence. So it comes out to be earnings before interest, tax, depreciation as well as amortization. Then what is the main goal of financial management? Another question, similar management. Maximizing profits, maximizing shareholder wealth, maximizing sales revenue, and maximizing market share. Acha, let me tell you what is connected. First of all, your salary, your sales and revenue increases. You earn a lot in terms of sales. Then you make a lot of profit. Then slowly and steadily, people come to know that you are making a lot of money. Your market price will increase, and at the same time, shareholders' money will also increase because after making all the payments, you will still have an ample of amount. So the answer would be B. Maximizing shareholder wealth. Next question. Which financial statements shows a company's revenue and expenses over a specific period? Balance sheet, income statement, cash flow, or statement of retained earnings? Which financial statement shows a company's revenue over the period of time? Right? We are taking up 1 year, 2 year, 3 year. We're just looking at revenues and expenses, nothing else. Balance sheet looks at assets and liabilities. Cash flow is about inflow and outflow. Retained earnings is what is left. So correct answer is income statement. So the correct answer is income statement. Done. What is the purpose of budget and financial statements? Budgets are required. Every year we have a budget in our country. Even why is it required? To track historical data or to control and plan for future activities or financial activities or calculate the market price, company's market value or assess the company's liquidity. We do not look at company's liquidity through this. We are not looking at the market value. We are not even trying to track the past. We are just anticipating our future based upon our past. So correct answer is to control and plan for future financial activities. Okay. So this is it for the day, everyone. I hope this class was useful for you. Now, if you would like to look forward to our courses, then what can you do? Okay, here comes the first question. Everyone, what would be the answer? In this balance sheet, the debt equity ratio is 2:1. The amount of long-term sources is 12 lakh. Okay, and they're asking what is the amount of tangible net worth of the firm. One thing is called debt. This is called debt, and this is called equity. The ratio is 2:1. And we have got that the debt part is what? 12 lakhs. So can I say 12 divided by equity is equal to 2/1? You know? Okay, I'm writing it here, everyone. Debt upon equity is equal to 2:1 is equal to 12 lakh divided by equity. So in this case, it's gonna be 12. So equity will go up and it is 12 divided by 2. It comes out to be 6 lakhs. Got the answer, everyone? So in this case, what's going to be the correct answer? The equity portion is going to be 6 lakhs. Yeah, it is going to be 6 lakhs only. The answer is wrong there. Okay, it is 6 lakhs. Acha. Everybody, the next question there. The current assets upon current liabilities. Current assets are of 4 lakh. Current liabilities are of 2 lakh. This part is given to us. If I have to find out the current ratio, can we do that easily? Yeah, we can. What we need to do is CA upon CL. It is going to be 2:1. If in this question they would have also asked about the current ratio. In that case, the current ratio would have been 2:1. Now they are also asking you about what is the liquid ratio. Under liquid ratio, we have liquid assets. What is the formula for liquid assets, everyone? In the liquid assets, we take all the current assets minus our inventory. Inventory is of 50,000 rupees. So from 4 lakh, remove that 50, it is 3,50,000 divided by 2 lakh. What's the answer then? 3,50,000 divided by 2 lakh. It turns out to be 3,50,000 divided by 2 lakh. Turns out to be 1.75:1. So the answer is 1.75:1. Okay, so the correct answer would be D, everyone. Difference between current ratio and liquid ratio is in this we take all the current assets. Here we take current assets but excluding two things. One is inventory, because inventory takes a long time to sell, and one is prepaid expenses divided by current liabilities. Done. Proprietors funds or shareholders funds is equal to. What do you mean by shareholder funds? Liabilities approach share capital plus reserves and surplus. Liability approach is share capital minus reserves and surplus. Liability approach is share capital divided by surplus. Achha, share capital includes two things. That is equity and preference. It includes equity share capital and preference share capital. Reserves and surplus includes all the specific and general reserves. Number one, specific reserves, the reserves which are for use only for specific purpose, and general reserves which are used only for general purposes. General purpose, specific purpose, and there would be one more. General reserve, specific reserve, and this will also include surplus. These are reserves now. It is called reserves and surplus. In the area of surplus, we include our profit. If we make an immense amount of good amount of profit, that would be called profit there. So in this case, the answer is going to be B. No, B has deduction. It would be A. Liabilities approach is share capital plus reserves and surplus. Next question. We have fixed assets. We have current assets. We have equity share capital, reserves, long-term debts. Now find out the proprietary ratio. Proprietary ratio would mean the ratio of the proprietor. Proprietor means the owner of the organization. So how do we find this value? It is going to be, proprietary ratio is going to be the part of proprietor upon total assets. So the total assets can be 5 lakh is fixed assets, 3 lakh is current assets. So can I say the total assets can be what? 8 lakhs. And what is the portion of shares there? If I look at the share of the shareholder, what is the part? Share here means the part that he has in the total capital there. He is having, as I told you in the previous question as well, shareholder funds includes 4 lakh and 2 lakh. You know, it's gonna be 6 lakh divided by 8 lakh in terms of percentage. So this is going to be proprietary ratio is equal to equity share capital divided by total assets or total liabilities, whatever way you look forward to, because both are equal ultimately. Now, total assets is equal to total liabilities. So in this case, the answer is going to be equity share capital. Total assets is 8 lakh and equity was 4 lakh plus 2 lakh, that was 6 lakhs. So this comes out to be 6 divided by 8. That is 0.75, or I can say 75%. So proprietary ratio is normally calculated in the area of percentages. Done, everyone? Let's look at the next question. We are given the opening inventory of 11 lakh, closing inventory of 1 lakh 50, purchases of 6 lakh, carriage of 25,000, wages, and they want you to calculate the ITR, that is inventory turnover ratio. How do we calculate it, everyone? The inventory turnover ratio. Inventory turnover ratio or ITR is equal to COGS divided by average stock. That's the formula. Okay, so let's look at this particular question, everyone. When we are trying to find the COGS, COGS is equal to opening stock, the formula for it, plus purchases plus direct expenses minus closing stock. So in this case, what do we have? 11 lakh plus 6 lakh, opening stock plus purchase. Carriage is a direct expense, everyone, plus 25,000 plus 2 lakh. And what do we have here? 11 plus 6, 17, and then minus the closing stock of 1 lakh 50,000. Okay, so what would be the answer in this case? The answer is going to be 11 lakh plus 6 lakhs plus 25,000 plus 2 lakh minus 1 lakh 50,000. So it's gonna be 17 lakh 75,000, everyone. Once we have got this amount of 17 lakh 75,000, this is our COGS. What is our average stock? Average stock is going to be 1 lakh, opening is 11 lakh, plus closing is 1 lakh 50 divided by 2. It is 6 lakh 25,000. So what's going to be the answer? 17 lakh 75 divided by 6 lakh 25 is equal to 2.84. I think I made a mistake in some calculations there. Opening inventory is 11 lakh. Yeah, it is 11 lakh. And closing is hardly 1 lakh 50. Probably there's a mistake in the question while calculating it. So 11 lakh plus we had purchases of 6 lakh plus we paid carriage plus wages minus 1 lakh 50. Yeah, it turns out to be 17 lakh 75,000 only. This is correct. Now let's look at the opening and closing inventory. It is 12 lakh 50,000 divided by 2. 625,000. So in this case, yeah, it's gonna be this only 17,75,000 divided by 625,000. That is 2.84 times. It is going to be 2.84 times. Probably the mistake is there because this should be 1 lakh as per the question there. The answer would be 2.84 times, everyone. Calculation mistake. Okay. Next question. Which ratio indicates the proportion of profit distributed as dividends to the shareholders? Dividend yield, earning price per share, earning per share, or price to earning ratio, or ROE. पता है PE is a very important ratio not only for ratio analysis but also in terms of the chapter module D as well. Then you'll study in the CIB as well. मतलब if you are investing time in PE ratio na, you're gonna use it in multiple areas. But in this case, we are talking about the dividend to shareholders. When you are giving dividend to the people, yield is basically what? How do you define the term yield, everyone? Dividend yield can be the income that you are receiving. So in this case, it is going to be the dividend yield. That dividend would be received by the shareholder. For a shareholder, this is income, isn't it? So in this case, the correct answer is going to be the dividend yield. Done? Next question. Which of the following ratios measure the overall efficiency of the company in generating profits from its assets? ROI, ROA, then GP or NP? What would be the correct answer? Which of the following ratios measure the overall efficiency of generating profits? That is return on assets, everyone. What is the money that we are receiving on the total assets which are invested in the organization? ROI is your profit divided by capital employed, that is your share capital plus long-term funds, while assets is all the assets. You take the profits and you divide it by the assets of the organization. So in this case, it's going to be ROA. Acha, everyone, the assets that we are using, we would always be interested in knowing now whether the assets that we are using in the business are they turning into a beneficial situation or they're being over exploited or we are just not able to do anything about it. है ना? So in this case, ROA, if it is good amount, na, it is actually better for the organization. That means we are making good amount of money out of it. What is the purpose of the ratio analysis of the in the financial management, everyone? In the area of FM, what is the purpose of ratio analysis? See, ratio analysis is super important. Why? To evaluate the performance of the employees. It has nothing to do with employees, everyone. To assess the liquidity, profitability, and solvency, we can say that. To determine the market share of a company, no. There's only one specific kind of ratio which talks about this. That is market test ratios, but it does not determine the market pressure. It just determines your market stability, your market share, the situation of that organization in the market. Nothing else. Huh? It asks us to calculate the tax liability of a company. If we talk about the tax liability of a company, how do we specify it? What is the purpose of ratio analysis? Ratio analysis is just to find out the analysis of the organization. पता है, this is actually a very strong tool of the financial analysis. Under financial analysis, we have comparative and common size statements, we have trend series, we have ratio analysis, and even CFS, cash flow statement, is also part of this. So in this case, it is done to assess the liquidity, profitability, as well as solvency of a company. If the revenue from operations, RFO, is rupees 1,60,000 and GP is rupees 40,000, and they want you to find the GP ratio. What's the ratio that is in this case, everyone? GP would be GP divided by sales, and this is normally calculated in percentage. This is a profitability ratio. So it's gonna be 40,000 divided by 1,60,000. In terms of percentage, it comes out to be 25. What's the ratio that is in this case, everyone? GP would be GP divided by sales, and this is normally calculated in percentage. This is a profitability ratio. So it's gonna be 40,000 divided by 1,60,000. In terms of percentage, it comes out to be 25. It's going to be 25%. Next, which of the following is to measure the efficiency of the management of the company in managing its accounts receivable? What do you mean by accounts receivable, everyone? Accounts receivable are debtors and bills receivable. Somewhere down the line, you don't really have to think much, because if it is exclusively for accounts receivable, it's gonna be the ratio related to that only. Debtors plus bills of exchange. So in this case, it's going to be accounts receivable turnover ratio. So it's going to be B. Next question, everyone. The last question for the day. Company's liquid assets are of 5 lakh. Current assets are of, current liabilities are of 3 lakh. Thereafter, it paid payables of 1 lakh. Okay. This was 5 lakh. And this was 1 lakh. No, this was 3 lakh. Out of 3 lakh, we have paid 1 lakh, and cash is also gone. One creditor is gone, the cash is also gone for the same. So it's gonna be 4 lakh divided by 2. So it's gonna be 2:1, because quick ratio is quick assets divided by current liability. Good morning, everyone. Welcome to Offices Adda 24/7. My name is Niharika Walia Bhatnagar, and I'm with you with the area of accounting and financial management for bankers. So today we'll be talking about the next level. The countdown has begun, and this is where we are moving on to one of the important topics, that is ratio analysis. We started with this particular topic, and I'm continuing with the basic questions. Slowly and steadily, I'll move towards the case study based questions of the same as well. So currently, I'm talking about only the era of one single questions, which is going to cover a good number of formulas. Right, so here comes the first question, everyone. The first question is related to the area of working capital. What do you mean by the term working capital, everyone? Do you know what's the meaning of working capital? Working capital is the amount that we need on a daily basis. So this means that if we talk about the working capital, how do we define the term working capital there? Working capital is the capital which is required on a daily basis by the organization for their needs, right? Whatever their needs would be, it is required for that particular purpose. So when we talk about the working capital scenario, what would be, what is the particular question asking right now? The question is asking that what working capital is the cash and bank balance, capital borrowed from the banks, difference between current assets and current liabilities, and then difference between current assets and fixed assets. What would be the correct answer in this case? Working capital is the daily operative requirements of the organization. Okay, so this amount is required by the organization to run its business. Right? Chale. Now let's look at the answer. It is a difference between current assets and current liabilities. The answer is actually C. Whatever we need for our daily basis needs is current assets, and then whatever we will have to pay at any point of time is current liabilities. So the difference between the current assets and the current liabilities is called working capital. So the difference between current assets and current liabilities, everyone. Next question. The current ratio is 3:4. Current liabilities is rupees 24,000 and the amount of current assets would be what? Okay, we are given CA divided by CL is equal to 3 upon 4 and the current liabilities are of 24,000 and we have CA here. So what would be the value? CA is equal to 3 into 24,000 divided by 4. 4 6 are 24. Now this means the particular amount of current assets would be 18,000. Take a look at the particular answer, everyone. Okay, just a moment. I believe it just went. Visible now? This is the answer. 3 into 6 is equal to 18,000. Done? So in this case, the correct answer is 18,000. Now, what would be the next answer, everyone? Chale. Now let's move on and talk about the next question. The next question says that the current assets are of, okay, they're asking you CA upon CL. The current assets are of 5 lakh, everyone, and current liabilities is of 1 lakh. From this, I can also make a particular question where I can ask you, what is the current ratio? Then revenue from operations is 28 lakh. They want you to find working capital turnover ratio. WCTR can be calculated as RFO divided by working capital. Current ratio would be 5:1. Second would be 28 lakhs divided by the working capital. The working capital would be CA minus CL. So in this case, if I look at this particular area, the working capital in this case would be 4 lakh rupees, है ना? if the working capital is 4 lakh rupees RFO or revenue from operations, which is also called sales, I'll divide it by the amount of working capital, which is 4 lakh. So in this case, what would be the value of working capital turnover ratio? The turnover ratios are always calculated in times. So what would be the value, everyone? So in this case, the correct answer would be 7 times. 4 sevens are 28. All the turnover ratios will be equal to, their expression would be as per times. Okay? Now moving on to the next question. Next question is, this answer was 7 times. Moving on to the next question, which says RFO is given for 2 lakh. Inventory turnover ratio is 5 lakh, 5 times. Gross profit ratio is 25%. Find out the value of closing inventory if the closing inventory is 8,000 more than opening inventory. That means closing is more. Okay. We are given the RFO and we are given GP as well. GP is 25%. Always remember, everyone, if nothing is specified, GP is always on sales. So how do we calculate GP? Whatever your 2 lakh rupees is your sales. From sales, if you remove the portion of your profit GP there, what you'll be left with is your cost. We're looking forward towards cost. It comes out to be 15 lakh. है ना? अच्छा, it is 1,50,000 ना? हाँ. So 2 lakh minus 25% will come out to be 1,50,000. So in this case, when the value of your cost is 50,000, this is our cost of goods sold. Once you get the cost, everyone, what will you do? Once you have the cost, let's find out ITR, inventory turnover ratio. ITR is equal to COGS upon average stock. One thing is sorted, that is COGS is equal to 1,50,000. But what about the area of stock? In this case, they are saying that for the find out the value of the closing inventory. If the closing inventory is 8,000 more than opening, let opening be X. So if I'm trying to take out the average, opening be X, then closing is X plus 8,000 divided by 2, which comes out to be 2X plus 8,000 divided by 2. So if I take the 2 outside in a common manner, on a common ground, what would be the answer? What would be the answer in this case, everyone? It is 8,000 now. So this is going to be, if I take 2 common there, what will happen? It is 2x plus 8,000. So can I take this particular point as x plus 4,000 divided by 2, and here we also have 2. है ना? This 2 cancelled. What are we left with? X plus 4,000. Isn't it? Our total would be x plus 4,000 is going to be our average. So 1,50,000 divided by x plus 4,000 is equal to 5. है ना? This is the point there. Once we get this amount, then what will we do? It is going to be 1,50,000 is equal to 5x plus 20,000. So what would be the answer? 5x is equal to 1,50,000 minus 20. It is 1,30,000 divided by 5. So it's gonna be 1,30,000 divided by 5. 8. The answer is 26,000, everyone. Oh, acha, 26 is the opening inventory, na? The closing is 8 more. 26 plus 8. Acha, everyone, showing it again, na, in case you are still having a problem there. First of all, let opening be X. Let closing be X plus 8,000. If I'm taking the average of these X plus 8,000 divided by 2. So can I take 2X plus 8,000 divided by 2 in such a way that I take 2 common, X plus 4,000 there divided by 2. So this comes out to be X plus 4,000. This is our average inventory, and the COGS is equal to SP minus profit. Our selling price was of rupees 2 lakh. And then from that you remove the profit portion, that is 25%. What are we left with? We are left with a cost of 1,50,000. है ना? Once you have got the cost, once you have got the average, what are you going to do? It's gonna be COGS upon average stock. And they have given the ITR as well. In this case, it's gonna be COGS upon average stock, na? So in this case, they have given the ITR. The ITR in this case is of 5. Yeah. So this is equal to 5. So you take directly 5 up on the 5 multiplied by X plus 4,000 in this case. So what will you do? 5 multiplied by X plus 4,000 is equal to 1,50,000. So in this case, it's gonna be 5x plus 20,000 is equal to 1,50,000. Okay? So in this case, what's gonna be the answer? Then what would be the answer? 1,50,000 divided by that would be 1,50,000 minus this 20,000 divided by 5. Just solve the last portion there, everyone. 5x plus 20,000 is equal to 1,50,000. Done, everyone? This is a trick question. Requires a lot of time and proper answering is required. Ultimately, you will have to solve this portion there. 5x plus 20 is equal to 1,50,000. Done, everyone? Let's look at the next question. To know the return on investment by capital employed, we mean. I wanted to know what is the return of investment. Net fixed assets, current assets and current liabilities, gross block or fixed asset. What will be the answer in this case, everyone? To know the return of investment by the capital employed. What do you mean by return on investment? Whatever money we put anywhere, we would always try to find out what is the return out of it that we are getting. And we are investing the money in some business there. That is why capital is being employed. So what will you call? Net fixed assets, current fixed assets, current assets minus current liabilities, which is working capital. Then gross block or fixed assets plus current assets plus current liabilities minus current liabilities. In this case, there is only one rule. That is fixed assets plus current assets minus current liabilities. This is required in every organization, everyone. Ultimately, fixed assets are required wherever they are. Their loans and everything has to be paid off. Then the area of current assets is required when the organization has, when it would be relevant for the organization when it would have loans and multiple assets again. Along with this, when we talk about the current liabilities and all scenario, sometimes the current liabilities can be said as the money that you will have to pay to the other person at any point of time. He can ask you for his money for any point of time. That is below 1 year. The next question says a company's current assets. The company's current assets are what? The company's current ratio is 2:1. After the payment of some of its creditors, ratio, what will happen to the current ratio, everyone? Chale, let's see. If the current ratio is CA upon CL is equal to 20,000, then CL is current liabilities, that is of rupees 10,000. Now in this case, after the cash payment, then what will happen to current ratio? Everyone, we are making some payment, we are losing money. That means you are losing money from the asset side, and also you're also losing the same amount of money as from your liability as well. Just to pay off your liability or to keep them happy, you will have to pay the money now. So in this case, what will happen? Will it increase? Will it decrease? Then we have as before or none of the above. So in this case, the correct answer is it would increase.